Welcome to CRE Fast Five, where we detail hot topics in commercial real estate in 5 minutes or less. I'm Carly Iacono, and tonight we are talking about zero cash flow investments. Zero cash flow has been a very misunderstood part of the net lease market for an extremely long time, but given today's current climate, it is becoming increasingly relevant. So I want to walk through with you what a zero cash flow investment is, give you a baseline understanding, and then give you some considerations about why in today's market it is increasingly at the forefront. So first, a basic definition. Zero cash flow means that the net operating income from the tenant perfectly matches the debt service on the loan. So after debt service, there is no cash flow, hence the name. Zero cash flow deals are typically long-term leases with investment grade credit. Often they are put in place when the lease is 20 or 25 years long, plus significant options thereafter. The debt is almost always completely non-recourse and fully self-amortizing. Now, there are some zero cash flow deals that do have balloon payments at certain points within the term. So just be aware of that. There are a few different structures floating around. But for today's purposes, we're going to talk about the most common structure, which is a fully non-recourse, complete self-amortizing loan. So why would someone knowingly purchase an investment property that does not throw off income? There are a lot of reasons, so let's go through them now. The first is the debt structure that we just talked about. So in addition to being completely non-recourse and fully self-amortizing, it is often a high leverage point. So if you are completing a 1031 exchange and you have a lot of debt to replace, that might be extremely difficult given the market today. So we're seeing banks, as you know, pull back on loan to value across the board. So if you need 70, 75, 80%, 85% loan to value to make your exchange work and avoid mortgage boot, this might be one of your only options. In addition, the debt is completely paid off by the end of the term, hence the self-amortizing structure, and it is paid off before the base term of your tenant expires in basically every case. So you have a very safe debt structure here without a lot of liability to the actual owner of the property. The second reason people take a look at these are for the tax benefits. Now, I'm going to pause here for a minute and remind you, I am not a CPA, I'm not an attorney, nor am I a 1031 intermediary, but I do a lot of deals at this structure, so I'm happy to share my thoughts, take this information, and go confer with your third parties. So the tax benefits really come from the passive loss structure that this type of investment creates. What I mean by that is if you have a leasehold interest that is 100% depreciable, you're going to have very significant depreciation on that property. In addition, if you run a cost segregation analysis and you consider bonus depreciation, you can have a tremendous shelter in the first few years of ownership. The third thing is the minimal equity requirement. Now, current market pricing on a leasehold is anywhere from 15.5% to 16.5% equity over the debt. I just brought one of these to market yesterday in Orlando, right next to SeaWorld, unbelievable location, and I priced it at 15.5% equity over the debt. Now, equity over the debt is not the same thing as percentage equity in the deal. So don't get those two confused. The investment that I just mentioned, 15.5% equity over the debt, translates to about 13.6% equity total in the deal. So just be aware that those are two different metrics. But zero cash flow deals are commonly talked about and priced as a percentage equity over the debt. They are not really cap rate deals. They're not priced per square foot. It's simply a metric over the debt balance. Now, if you're looking at a fee simple zero, that pricing is going to be a bit different, anywhere from 25 to about 27% equity over the debt. So a lot of the tax benefits, a lot of the depreciation and the interest expense really can be best realized with a zero cash flow leasehold as opposed to a zero cash flow fee simple deal. So keep that in mind as you're looking at different options as well. The next reason people take a look at these are because you can really control significant real estate with very minimal equity. The Walgreens in Orlando by SeaWorld that I just mentioned to you, the equity requirement is about $545,000. So not a lot for an incredible drugstore location. So I have several clients who have amassed massive portfolios of real estate around the country by this very strategy. They will input minimal equity and put it into a trust or an estate plan for their children long term. The debt self-liquidates, and at the end, as the tenant begins exercising options, you have a very strong cash flow portfolio. So it has some interesting benefits for an estate planning or long-term hold perspective as well. The last thing I want to mention is the pay down re-advance feature. So this is part of the loan documents. This is not a creation or something that you negotiate during the deal. It's actually already structured in the loan documents. So very straightforward. And what pay down re-advance allows you to do is invest or temporarily pay down the debt balance on the loan in effort to satisfy the equity requirements of your 1031 exchange. You can then re-advance that loan a few days after closing and pull out any excess equity that was not required to purchase the deal. So if you have 15.5% equity required to purchase the deal, but you're temporarily paying down the loan with 50% equity, you can then re-advance that excess 35% right at closing and take that as cash with no tax liabilities. Again, speak to your 1031 intermediary, but we do this a lot. So that allows you to then go play the stock market, buy a boat, pay for your kids' college, whatever it is, without being subject to capital gains from the sale of another asset. So really interesting option if you're in a 1031 exchange and you do want to pull money out. So as you can see, there are a lot of benefits for 1031 buyers, for private clients looking to just have a long-term estate plan, and then also for owners that have a larger portfolio that need to shelter income from other sources. Obviously, there are some complexities to this type of asset, so if you have a specific situation or you would like to explore these deals further, please give me a call. I'm happy to walk you through. That was CRE Fast Five. I'm Carly Iacono. I look forward to seeing you again soon.